Hello guys, this is the Successful Investor Club, the place where we learn how to invest and do not speculate. In this video, we'll answer the question where is the inflation, why are we not seeing it, and where to invest our money in order to take advantage of the cycles that is yet to come. At the end of the video, we'll talk about one of the greatest investment opportunities in recent decades. So watch the video until the end. None of what is said here will be based on my personal opinion because it does not mean nothing. We'll look at various facts and most importantly, we'll look at the history of the macroeconomic cycles that dictate our daily lives. As Winston Churchill has once said, to see ahead into the future, we simply have to go back into the past. The point of this quote is that an economy is built on cycles that repeat over time, and by looking back at these cycles, we can predict how the future will look like. These cycles don't always occur in the same way, but there are always similarities. If you like these videos and want to help the channel grow, subscribe to the channel and like the video. Inflation is the decline in purchasing power of a given currency over time. For example, if today $1 buys 2 loaves of bread, then in 10 years that same dollar will only buy 1 loaf of bread, for example. What inflation depends on is the rate at which money printing increases. This graph shows the balance sheet of the Federal Reserve of America. In 2008, the value of assets held by the Federal Reserve was $800 billion. These are assets brought by the Federal Reserve because there was no one else to buy them. Purchases with the idea of preventing a crash in the markets. Since the crash occurs when a buyer is not found, the Federal Reserve prints the necessary amount and buys the assets themselves. This artificially stimulates the system and prevents the free market from dictating the development of the economy. At the end of 2008, the figure is already over 2 trillion, and in the upcoming years it doubled again to 4.5 trillion, and we saw a momentarily plateau of 3 to 4 years. During this time, the Fed is neither buying nor unloading its assets. Briefly, for 1 year between 2018 and 2019, we see them trying to unload their assets, but unfortunately not successfully. The interesting thing here is that even before 2020, and more precisely before the COVID pandemic, the Federal Reserve pumped over $500 billion. This is known as the repo crisis, which affects banks' liquidity and how they lend loans to each other. If the Federal Reserve had not intervened, we would have had a financial crisis starting again by the banks. The same is the one in 2008. But the fact that intentionally everything was covered up by almost all mainstream media with the idea of not bringing panic into the markets, you can only find a few articles in CNBC and Reuters, lost in their pool of many other articles. I'll put a link in the description. Just for 2020, the assets on the Federal Reserve's balance sheet have nearly doubled, reaching its current level of 7.4 trillion. In just the last 12 years, the assets bought by the Federal Reserve have multiplied by 10. For a little context, the Fed was created in 2013, meaning it took them 95 years to raise the first 800 billion, and then in just 12 years, the figure is now 10 times more than in 2008. This is something absolutely incredible. The other way that central banks can manipulate the economy is through the so-called prime interest rate. This chart shows the prime interest rate of the Federal Reserve for the period of 1950 to 2020. This interest rate determines the cost of any type of lending. If the prime rate is low as we see it now, it is at historically low rates, unprecedented levels. It will also keep interest rates on home loans low, car lending will be cheap, interest rates on consumer credit will be low, and so on. This artificially makes the economy grow because it grows based on credit. When there is more lending, the economy grows more. When there is little lending, the economy does not grow as much. And since lending depends on interest rates, This directly puts all the power in the hands of the Federal Reserve and the central banks, and all that 7.5 trillion of debt that the Fed has accumulated does not allow interest rates to be raised because the amount owed is increased and it cannot be repaid at the moment, precisely because it has to constantly print new money in order to pay off current debts with it. By law, this is called a pyramid and is illegal, but they are the central banks of the world. There are no laws for them. The thing that can cause interest rates to rise is inflation, and you can see this chart that the last time there was high inflation was in the 1980s, during the 1970s to 1980s period. This caused the interest rates to rise in the 80s to counter-react to the inflation and stop it. The difference between the 80s and now is that in the 80s we were in the middle of the so-called debt bubble, and now we're at the end of it. The numbers are so large that it is impossible for interest rates to rise, as the system will collapse. There will be no one to pay the debts to the central banks. That's why the only solution is to print money, which in turn will inevitably bring inflation. If that doesn't give us enough confidence in whether there will be inflation or not, we can look at the Federal Reserve Chairman Jerome Powell and what he says. Mid-summer of 2020, he came out and announced that the Fed's new target is an average inflation rate of 2% to be achieved. What would average mean in this case? Would the Fed let inflation go to 4, 5, 6% because for a long time it was only 1%, and when you sum up the two and divide them it's around 2%? Well, that's actually not how an economy is supposed to run, and for sure this is not a correct way for a central bank to give guidance. Before this decision is made and before those words were spoken, they were carefully discussed over 100 times. This is the head of the Fed. The whole world is listening to what he has to say, and by saying this, the Fed ensures that they will have extra time if they let inflation get out of control. Out of control in quotes, because it is a macroeconomic factor, meaning something that cannot be controlled. This chart also shows something that has never happened. The fact that every single major central bank in the world is printing mind-blowing numbers. The chart is from 2014 to 2020. Other times in history, a country has taken this path. Now, every country has taken it, and inflation is inevitable as there is no chance other than printing even more money. This is a graph of the Fed's balance sheet again. This is England's central bank balance sheet. This is the BOJ, Bank of Japan's balance sheet. And this is the ECB's balance sheet. Now let's discuss why we do not see inflation even though unprecedented amounts of money are being printed. Let's start with the official name of inflation, and that is CPI, or an index that serves to measure the rise or fall in the price of basic products and services we use. The acronym stands for Consumer Price Index. The problem with this index, or the way inflation is measured, is that it does not include food and energy, which are the two vital things as we are living people and we need them. A few years ago, when I found this out, that the CPI does not include the food and the petrol costs, I was shocked and did not believe it initially, but unfortunately this is a fact. The basket with the main products and services that is used to measure inflation does not include the food we eat and the energy we use. They are the basics and they are excluded from the basket. Instead, they are things like insurance prices, clothing prices, etc. This graph from Axios shows the global rise in food prices. The difference is not drastic, but we can see how it is accelerating and growing over time. This shows us that the real inflation is higher than that shown by the CPI index. Another factor that also shows inflation is that massively people in America say the food prices at the supermarket are going up quite a bit. However, in this video, we're just going to talk about statistics and pure information. So let's continue. The third main factor why we do not see inflation yet is the so-called term money velocity, which is used to show us what rate the monetary volume is circulating at. When money velocity falls, it can tell us two things: that people are spending less and that people are investing more. This is because the money velocity volume slows down as big part of the money gets stuck in one place. You could look at it as putting money under your mattress. The speed of their exchange or the circulation speed will be zero as they sit in one place. If trillions are printed but all of this money is hidden under some person's mattress, in this case, the mattress stands for real estate assets, stocks, or savings accounts, there's no way inflation in product prices or services will form, because this money does not circulate in that part of the economy. The other point is that the velocity of money exchange is further slowed by the current pandemic. Everywhere, every cafe, every bar or restaurant is closed. But this will not last forever and will end relatively soon, and therefore accelerate the money velocity. The third factor contributing to missing inflation in the US is that the US was the first country to export its inflation, because the American dollar is the world's reserve currency. Americans are such privileged people that they can print money out of thin air and then buy products from other countries with it. Then those same countries can buy America's debt because it's considered a so-called safe haven asset. This name is used for assets that are considered to have the closest to zero risk. Such assets are considered the dollar, the euro, the yen, gold, and US bonds, which represent America's debt. The main buyer of US debt is China, and they hold over 1 trillion of the US's debt, which stands at $27 trillion currently. The geopolitical conflicts between China and America will sooner or later lead to China abruptly selling its portion of the debt to America, and when no buyer is found except the Federal Reserve, this will signal the rest of the world that there is no other option but to print this money, which will also lead to the end of the US dollar as a global reserve currency, becoming a domino effect affecting every other fiat currency in the world, something that is getting closer every day. As time goes on, the dollar is being used less and less, and as all those printed dollars come back to America, it will raise the money velocity, increase the number of currency circulating in the system, and there will be a huge inflationary cycle. Now, before we get to where to invest our money, let's first say the so-called major investment groups and what are they characterized by, and which one has the most potential. In future videos, we'll do more in-depth analysis on each asset group. The first asset group is stocks, then real estate, the next asset group are bonds, and the fourth group is commodities. Now we can say that we have a fifth group, and that were cryptocurrencies. I will mention them at the end of the video and more thoroughly in subsequent videos. We start with the real estate group. This is an article from the International Monetary Fund in which we can see how they talk about the fact that in almost every country, property prices are at all-time highs. The next active group are stocks. The average growth in the S&P 500 index since its creation is about 10% per year, with inflation included. Without it is between 7 and 8% per year. This would say that on average, every investor can double their money every 10 years. Looking at the graph of the S&P 500 index, we can see that over the last 12 years, the index has risen 6 times. Also, given that the average PE ratio of the S&P 500 index in historical context is 15.6 and we are currently at 45. It is safe to say that stocks are in a huge bubble, historically speaking. Sooner or later, this will end, but no one can tell us when the stock market bubble will burst. But it all depends on how far the Fed is willing to go with their money printing. There is a world in which the S&P 500 index goes to 10,000 the next 2 to 3 years, but it will not make you richer, as in that world prices of all sorts of products will also have gone up quite significantly. The other option is to have a crash that drives people out of the market and the Fed fails to restore people's confidence and reassure them that everything will be alright because of the money printing. No one can say for sure exactly the way things will go, but one thing is for sure. We will see what high inflation is with our own eyes. The third active group is that of bonds. On the chart you see the biggest bubble in financial history, the 10-year bond of America. Undoubtedly the biggest bubble in history. Right now the annual interest rate for owning the 10-year US Treasury note is about 1%, which is the lowest level in history. The interest rate of a bond tells us what the degree of risk in investing in a country is. The lower the interest rate, the less risk is considered. The higher the rate, the greater the risk. At the moment, judging by the 10-year US Treasury bond, the risk has never been lower. According to it, we will not see inflation soon, downturns in the economy, or anything at all. Yeah, but that won't be the case. Imagine a pendulum. The bigger the imbalance of one side of the pendulum, the bigger the imbalance on the other side will be. Now the risk is considered almost zero, but these are cycles, and as everything is bright now, a moment will come when everything will be dark, and you want to prepare for that moment to make it good for yourself. The moment inflation surfaces, the bond rate will start to increase rapidly, since no one wants to hold bonds in times of inflation, because at the end of the bond period, the expiration date as it is called, you get paid fiat currency, whose value evaporates because of inflation. The bond market will crash subsequently. For contextual and a bit of historical perspective, in the year 1999 and 2000 was the dot-com bubble, a bubble that was only in stocks. Then in 2008 and 2009 it was a financial crisis and mainly a real estate bubble and the stock market bubble. To forestall the momentary collapse of the global financial markets, we are now in a bubble that covers stocks, real estate, and especially we see a colossal bond market bubble, whose collapse will lead to the economic doom of multiple countries, because this bubble is at the highest level, the country level. Moving on, the next future bubble, which has not yet begun to inflate and is extremely underestimated, we've come to the last sector. The sector that has the most potential is the commodity sector. In the 1970s, when inflation last hit America, the best performing asset were gold and silver, and the so-called mining stocks or miners, respectively. Inflationary times, people instinctively turn to gold and silver. This has happened many times in history and will continue to happen. In times of inflation, gold and silver are usually one of the first commodities to see a sharp jump in prices. Still, there will also be a sharp jump in oil prices, because oil and inflation are directly correlated. The same linkage to inflation is with the copper price, as these commodities are needed for almost every type of industrial activity. This chart shows the price of commodity sectors relative to the price of all other sectors in the S&P 500 index. The chart shows how undervalued or overvalued the commodity sector is compared to other industries in the S&P 500 index. The red line shows its long-term average, which is 4. The chart is up to 2017, and then we were below 1, and now in 2021 I can tell you we are closer to 0.5 than 1, because in the past 3 years the commodity sector has hardly grown, and at its expense absolutely all other sectors are constantly setting new highs, like the tech sector, for example. When the other sectors are growing more relative to the commodity sector, it falls relative to them. So with that in mind, let's look at what's been going on back in time, as Churchill would have advised us. We see that every time the commodity sector is so undervalued relative to other sectors, it explodes upwards. Knowing this, we can see that an incredible opportunity lies here. As Warren Buffett says, we want to be greedy when others are fearful, and we want to be fearful when others are greedy. And here again, imagine the pendulum. The greater the imbalance on one side, the greater the imbalance will be on the other side. We'll never go from being extremely undervalued back to just our average level, in this case 4. This is how the economic laws work. Even if you only get to 4 and assume that the current level is not 0.5 but it is the level of 2017, which is about 0.7, this gives us the opportunity to make almost 6x our money. You already make up your mind how optimistic or pessimistic you want to be. I am in this case quite pessimistic, or as Buffett would say, the margin of safety is pretty high. The higher the inflation, the more the commodity sector will rise relative to other sectors. If we get to 10 and assume we are at 0.5 currently, that's 20x your money. Judge for yourself your optimism, but know that these are inevitable economic laws. Like the law of gravity is inevitable, so the law of inflation is also inevitable. Thanks for watching until the end. Subscribe to the channel if you haven't and like the video. Thank you and see you later.